Welcome back, you legends. Let's get right into this quick post Nvidia earnings stream. Let's get into the details. Revenue 30.4 billion. Beat the estimates of 28.7, and then we had earnings 68 cents, beat the 64 cents estimate. We also had Nvidia announce a $50 billion stock buyback pending. So Nvidia beat both the top line, the bottom line. They also raised guidance, and despite all of that, the stock tumbled. This pretty much explains it, right? So if we take a look at Nvidia's past earnings, you'll see that since October of last year, every successive earnings report, Nvidia has beat both EPS and revenue, but those beats have been shrinking. That's because expectations have risen, and the rate at which the company has been growing simply is not sustainable. It has to slow down. It's not because there's not enough demand for AI chips or anything like that. It's because the company simply grew so fast last year that it simply cannot keep that same pace. It's way much bigger now than it used to be last year. So expectations are higher and beats are shrinking. That led to this kind of post-market dump today in Nvidia. So here's what to look for tomorrow. So the expected move to the downside is about 115 bucks, to the upside 142 bucks. We already broke to the downside. We're now trading at the 50-day moving average. A lot of people think that earnings reports are all about the numbers, right? Did the company beat? Did they raise guidance? Nvidia did all of that, right? They beat revenue, EPS, they raised guidance, and they approved a stock buyback, and they still sold off. That's because earnings are not about the numbers. Earnings are simply about sentiment, right? So sentiment was way too optimistic heading into the report, and now that sentiment is getting pared back just a little bit here. If we take a look at the S&P 500 and NASDAQ 100 charts, both of them actually indicate that more downside is likely coming. However, how this plays out tomorrow is going to depend on whether market makers are able to kind of lift price up back near to where it closed today. It does not have to completely recover, but if they open it, let's say, about $1 short of where they closed it today, that likely means they will sell all throughout tomorrow, right? Because big market makers, they cannot dump a lot of positions. They can't open a lot of positions in after hours or the pre-markets. So they have to do all their trading tomorrow in the real money market, right? So after the market open, after the opening bell. So what they kind of need to do now is they need to manipulate price higher back to where it closed yesterday. This will create the illusion that things are okay, and then you have retail traders jumping in the first hour of the market. That's usually what happens. Retail likes to trade near the open. Big money likes to trade near the close. So what they'll try to do is they'll try to push price higher, recover it very close to where we closed today, and then they're going to try and sell throughout tomorrow if they're able to do that. Now, on the other hand, if we actually open lower, let's say we open significantly lower, all the way down at 115, it will make absolutely no sense for any big name to dump Nvidia after such a huge down move. So actually, if they gap it much lower than where it is now, so let's say 115, it will likely mean that we will have bottomed by the open, and then we'll get a rally. If they open it close to where it closed today, they'll likely sell it. And if they open it much lower than where it is today, you'll likely see something that looks like this, a rally back, and then they might try and sell it. If they open it at 120, where it is right now, you can expect something that looks kind of like this. You'll see some buying in the early session, and then they'll try to dump it, right? They'll try to sell it as close as possible to where it closed today. Why do I say all of that? That's a lot of jargon, right? Let's actually take a look at what happened over the last 12 months, right? I have the earnings tagged here at the bottom, right? So if we take a look at the last earnings report, they gapped it higher, and then they continued to rally, exceeded the prior highs, and then that just gave us the all clear, right? Once you exceed a significant level of resistance like this and open it higher, that means you have the go-ahead to continue to rip to the upside. We actually have to go back significantly further back to see any kind of negative reaction to Nvidia earnings. The last time it happened was in the November 2023 report. Here's exactly what happened. Market closed near the highs. Nvidia closed near the highs. The market then opened, and Nvidia opened very close to where they closed it the prior day. They had this fake out rally, and then they dumped throughout the remainder of the day and for the next couple of weeks. That's why I say if they open it close to where they closed it today, they'll probably continue to dump positions. If they open it much, much lower, then you can expect kind of a bounce back. If we go 24 months back, that means 2 full years back, the only negative reaction with a gap down, that is the market or Nvidia opened with a lower gap the next day. It happened only once out of the last 8 earnings reports. It happened only once. This means if they open it lower tomorrow, that'll be only the second time that happened. And to me, that'll signal a major sentiment change in Nvidia, because this was kind of the sure thing trade for everybody basically in the market. The common wisdom was just buy Nvidia and hold it and you'll be fine. Now that things are getting a little bit more turbulent, especially if they open it lower tomorrow, I think that'll sour a lot of retail traders, swing traders, a lot of these quick in and out folks. They'll start to think twice about going as aggressively into Nvidia going forward. So let's actually take a look at the S&P 500 and why all of this makes so much sense. So I discussed this key level 555 at my last video. I said this is the first level of support, minor support. Then we have the major level of support much lower at 547. Why is this a key level of support and not 555? 555 is a minor support because it held only once and it was part of this trading range. This was a bearish distribution pattern. We know now that for a fact, because we had this diamond top pattern break to the downside today. That breakdown was confirmed very early in the day. Right, we had this clear breakdown that told me that we will sell down all the way to 555 today. If Nvidia misses, and they did not really miss, but they did have a negative reaction, we will likely see a move all the way down to 547. Once that is done, once that is complete, that will likely be a tradable bottom for another move higher. Now, there are no red flags in Nvidia's report, I have to admit. It was a very good report. Beat top line, bottom line, raised guidance, massive profits, net income, 16.6 billion. They are printing money. Nvidia is not in trouble, okay? Nvidia is not in any way in any sort of trouble. They're making money hand over fist. The company has an amazingly healthy balance sheet. They honestly have very little competition. The only competition they have is from AMD, and AMD expects to make 4.5 billion in revenue for the entirety of this year from AI chips, right? 4.5 billion in revenue, not profit, revenue. Out of that 4.5, I believe AMD said they'll make about 1.2 something like that billion in profit. Nvidia made more than 10 times that profit just this quarter. So I mean, to bring it home, Nvidia is not in any sort of trouble yet. You'll start to see more of that confirmation that Nvidia is in trouble when you see guidance getting lowered, when Nvidia starts to actually miss. I actually took a look at Nvidia's earnings reports going all the way back to this period in 2017, 2018. The way this kind of crash happened with Nvidia is not because they missed earnings. They did not miss. What happened, actually, if we take a look, the entire sell-off happened between 2 earnings reports, right? So the company did not crash after a report. The report was already out. Nvidia beat, and the crash happened anyway. Goes to show you that stocks like Nvidia, the AI trade, is mostly a sentiment trade. It's not a fundamental trade. So a lot of folks will be looking for hints in the report. Oh, maybe trouble is ahead, whatever. That's not what you need to be looking at. Look at this. Just one single quarter, right? Nvidia reports here, continues to rally after the report, right? Continues to rally, then completes a double top, still hasn't reported, crashes all the way down, and then reports and still beats. So it's a sentiment trade. Don't try to overthink it too much. It's mostly a sentiment trade around AI and Fed rate cuts coming next week, and that's how I'm looking at it. That's how I'm trading it. That's how I'm trading the entirety of the market, to be completely frank. So going back to the S&P 500, we had a diamond top pattern breakdown. A diamond pattern is a bearish distribution pattern. It is only confirmed once we get a break below the support line that happened today. This gives us a confirmation of the break. Now, the full measured move for this kind of top is you measure from the top to the bottom, then you take that distance, and then you move it to the downside. That gives you the full measured move. Full measured move is actually, let's see, 546. So it was just a dollar below my already existing 547 target. So 546 is the full measured move. That means this gap could potentially get filled. It may remain unfilled. We don't know. But what I would say is, inside of this gap is where you'll find very strong demand, right? We had significant demand, significant demand. When you see a gap and run like this, you know there's very strong support at this gap level. So 547, 546, major level of support. Likely we tag that level this week, potentially next week, I would say. Probably this week, because the stochastic is now trending down, but it has not entered oversold conditions. We only buy after the stochastic enters oversold conditions and then produces a bullish cross. I gave you a few examples of this. This signal works very well in an uptrend. In a downtrend, it does not work. That's why I don't use it to buy in a downtrend, right? I use it to sell in a downtrend, and I use it to buy in an uptrend. So it's a trend following signal. Buy in the oversold condition. When you get a bullish cross, call the bottom here. Do that again here, calls the bottom perfectly. Let's do that again here, calls the bottom. Basically, the market stays flat for a week, but does not break the low. And then even as the market transitions from an uptrend to a downtrend, you see this bounce at the bottom, tags this major support line, and then bounces back up. And then when the downtrend is confirmed at this breakdown, you only use it to sell and not to buy. Right here, calls this top. Again here, calls that top. Right, and then you see that transition again from a down trend to uptrend. And actually, if I draw a trend line that connects these lows, you'll see that it broke. However, if I connect the same kind of trend line in the futures market, you'll see that it did not break, and it actually coincides with that same 547 level on the SPY ETF. So this is a major level of support. If the market opens very close to where it closed today, expect some kind of weak counter rally to start the day, and then continuous dump all the way to tag this level, potentially tomorrow or the day after. After we tag it, I think we bottom. We form a local bottom at least, and then we get a counter rally. If that counter rally fails to take out these highs, then we actually confirm a major downtrend that connects these major tops, and that will likely lead us all the way into sometime late October, as is seasonally indicated, right? We usually get this major top at the end of August, early September. Then we get a couple of months of significant selling, September in October, in election years. This is when we have an open field. When it's more a run-of-the-mill kind of election year, we tend to get a much stronger November and December. That's basically the only difference. We tend to bottom late in October in both cases, but in an open election year, we tend to get a much weaker November and December. Okay, I hope I covered all of the scenarios that we could be facing tomorrow. I'll check your questions very quickly. If you have any questions, I'll try to answer them as quickly as possible, and then we're going to end this stream. Oh my goodness, 680 views. Thank you guys. Smash that like button right in the face because we have 55 likes and 680 viewers and only 55 likes. Come on, guys. Come on, guys. Okay, somebody asked about Bitcoin. So Bitcoin had this beautiful kind of bottom tag, this major support level, right? If we zoom out a little bit here, you'll see that Bitcoin has been trading perfectly within an uptrend clear support at the bottom, clear resistance at the top. And since then, we've been trading inside of this bull flag. Now, I do expect this bull flag to break out sometime, let's say October, let's say sometime late October, early November. I think we'll continue to trade inside of this flag until early November when we get a breakout. After that breakout is complete, I think we rally all the way to $120,000 plus for Bitcoin, due to main big reasons. Number one, rate cuts. Bitcoin loves rate cuts. It's a rate sensitive asset. Number two, inflation, and not the kind where you have expensive groceries. I'm talking about devaluation of the dollar. Lower dollar, stronger Bitcoin. Lower interest rates means even more declines in the dollar, means even higher for Bitcoin. Okay, so Bitcoin will kind of rally very strongly into at the end of this year, maybe early next year, until we actually hit a recession. After we hit a recession, I think Bitcoin kind of completes that cycle and crashes back down. Until then, rally inside of this flag and breakout probably November. In the medium term, near term, we had this very beautiful tag of the bottom. Then we had this cup and breakout, very similar to what looks kind of what happened here. Tags it. Then we have a cup, then a breakout. Again, we tagged it here, cup and a breakout. Unfortunately, what happened differently this time is that Bitcoin, after it broke out, instead of holding kind of this level as it pulled back, it broke, right? It had this nasty breakdown post-market yesterday. And it kind of looks like what happened here, right? We had this cupping formation breakout, then it flagged, and then it broke down. The second move higher matched the prior highs. We did not get much higher than that. That tells me that likely we will get a bounce back in Bitcoin. Probably tomorrow or today is the bottom for Bitcoin. And as the market bottoms at 547 and the rest of it, I think Bitcoin will rally back and at least match these prior highs. Let's do super micro. Very bad report came out from Hindenburg that they were cooking the numbers. Now, here's a stock that was kind of going crazy, right? Huge breakouts, long consolidations, massive breakouts, then consolidations. Unfortunately, it's kind of the trade where if you miss the breakout, the first breakout on the consolidation, or the second breakout after the consolidation, really you can't go long here. You can't go long here. You cannot go long here. You'd be kind of guessing because it just keeps ripping and there's no pullback. Now, unfortunately, when we had this pullback, when we had this consolidation bull pennant pattern, it broke right here. Then it moved significantly lower, moved back up, did not tag this again. This was very bearish. It failed to even backtest this prior level of support that is now resistance, crashes again. Where do we look for a major level of support? Not far actually. This is where I would look for a major level of support to reestablish itself. Kind of in here, 355, 357, somewhere in here. Despite what Hindenburg says, despite all of that, I think the company has sold down enough. Look at this, 67%. We go back to this key level, and if it holds that'll be a 72% retracement. Then I'll be looking at some kind of support here. Unfortunately, though, the long-term trend has already been ruined, right? Because it had these consolidations, breakout, consolidations, breakout, consolidation, breakout, consolidation, breakout, consolidation, breakdown. Right, so this is very bad. If you're kind of trapped in this name, I'd be looking at some kind of support to hold in here, then for a counter rally back at least to this neckline at 500, about 500, potentially slightly higher, very likely will not exceed these highs for several months. So not my favorite setup now. I'd probably completely just avoid trading this kind of setup because it failed, right? It had this very beautiful, absolutely gorgeous uptrend breakouts after each consolidation, and that completely failed very recently. So this uptrend is clearly now ending, and we're now establishing a new downtrend. Somebody asked about Tesla, so let's do Tesla very quickly in here. Let's check out Tesla. Right, so Tesla had this very clear prior level of resistance. This is now a level of support, right? We had this move all the way back down to 190. This was the major support level, major buy. We had now a counter rally, a pullback at this range between 200 and 210. In my opinion, this is still an attractive level for Tesla. I'd be looking for Tesla to continue the rally and move back at least to these prior highs, right? To something that looks like this, at least back to these prior highs after we establish that bottom on the S&P and the NASDAQ, right? After we complete this local bottom, expect a counter rally. And then again, if that counter rally in the S&P fails to make a new high, we'll have confirmed a new downtrend. Otherwise, this is just a pullback in a longer term uptrend. And again, if I take a look at the S&P 500 futures, still looks like an uptrend. Tag this a trend line once, twice. We will likely tag it again in the next 24 to 48 hours, and then bottom and then rally back up. Gold, it had this very clear consolidation pattern with higher and higher lows. Actually, it doesn't just look like a consolidation pattern. This looks like textbook a volatility contraction pattern. That's right, volatility contraction pattern. High volatility, still high, lower volatility, lower, lower, lower. So when you see volatility kind of contracting like this, that is very bullish. Volatility tends to accompany downside moves. Lack of volatility is bullish. A volatility contraction pattern indicates that volatility is escaping this kind of trend, right? We had this large range, then we established this smaller range. Now we're establishing an even smaller kind of range. My upside target is still at 240 for gold. It is not overbought enough, in my opinion, to form a top. And the dollar is still declining. In fact, if I take a look, let me check where's the dollar. I have it somewhere in here. Boom, here's the dollar. The dollar actually broke below a major level of support. Major level. Broke it. This is very bullish for dollar, bullish for stuff, for gold, for Bitcoin, for commodities in general, especially defensive commodities and metals like gold. And if we actually just draw on here this kind of range, right? And then when we get a range breakout that looks like this kind of a range breakout, right? Multiple attempts at a breakout. The last breakout held at the top of the range. This typically means we double the range. Let's take a look at what that looks like. Boom, 240 exactly. So I could just redraw stuff. I don't need my notes. Okay, so 240 still my target for gold. Silver not as bullish. Here's why I'll show you why silver is not as bullish. Let me add gold on here so you guys can see. So silver up top, and then we have gold down here in the blue and black, right? So this is gold. This is silver. Some I don't know why miraculously silver still has my notes, gold doesn't. Anyway, so here's why silver is kind of trash. Low, lower low, lower low, lower low, lower high, lower high, lower high, right? Whilst gold is making a low, higher low, higher low, higher highs. So really, you don't want to be trading silver when it's underperforming gold like this. Just stay away if you want to trade expensive metal. To go stick to gold. I don't like silver here. Maybe if it breaks above this resistance line, I would reconsider it. Otherwise, just stick to gold. It's superior in this case. Let's talk about recession. Somebody asked about recession, so let's discuss recession. Down below is the 10-2 yield curve. Each inversion, guys, usually is followed by a recession. About 12 to 18 months later, right? Recession following the yield curve inversion. Here it is. Boom, yield curve inversion, recession, recession, even before the pandemic, recession, and then inversion, and we're still awaiting the recession. I think it's absolutely inevitable that a recession is coming. I think there's absolutely no question that a recession is coming. Anybody who says otherwise, I think is just fooling themselves. No chance in heck we have a yield curve inversion this deep, this long, and we don't get a recession. Recession usually means 30%, right, to 50% declines in the S&P and In tech stocks, that usually means a lot more than that, 70, 80%. Think about Nvidia crashing from 130 all the way back down to 500, 400, that kind of recession. So with that being said, it's really not time to panic until and unless three things happen. And I discussed these kind of three things in a couple of videos in the past. So let me go over them very quickly, right? Number one, we have a yield curve inversion. The first major, I would say, red flag is going to be once once rates begin to normalize, that means the 10-year note produces a higher yield, okay, versus the 2-year note. Once that happens, once the 10-year yield is again higher than the 2-year yield, that means the yield curve is normalizing again. That is an exceptionally good tool at timing the market top. Not the recession, but the actual top in the market. Here are a couple of examples that I already annotated on the chart. So in the 2000 to 2002 recession, the yield curve normalized about 3 months after we had the market top. In 2007, the yield curve normalized several months before the top, about 3 months before the top. In 2019, we had the yield curve normalize about 6 months before the market topped. 6 months, 3 months, something like that. The market top will usually develop between 3 to 6 months before or after the yield curve normalization. With that being said, 3 to 6 months, not tight enough. I need to know for sure, right? Six to 3 months, not great, not great. So in that instance, let me pull up here it is, imminent doom indicator, that is TLT relative to the S&P 500, or what I dub the imminent doom indicator. Here are the two rules to follow with the imminent doom indicator. Number one, you absolutely need a yield curve inversion. Without a yield curve inversion, you'll get a bunch of fake out signals like this. So number one, you need a yield curve inversion. Check. Okay, check. Number two, by the way, smash that like button. Okay, number two, what else do we need? We need the 10-month moving average. This little orange line, right? You see it? You see that little orange line? You want to see the imminent doom indicator close above the 10-month moving average on a monthly candle. Tried to do it this month, failed. Tried to do it several months before when we were actually bottoming, failed. Tried to do it multiple times as the market was topping, failed. When did it last succeed? When we actually had a yield curve inversion. Well, take a look at this beautiful, beautiful chart. Here it is. 10-month moving average, closed above it, called the top perfectly, right? So you want to see, basically what this chart tells you is that when you have, number one, an inverted yield curve, and number two, when long-term treasuries begin to earnestly establish a significant lead over the S&P 500. That's basically what this chart looks at, right? It looks at TLT relative to the S&P. So when bonds significantly outpace the market in an environment where we have an inverted yield curve that has already normalized, that's when you get the recession. That's when you want to exit the S&P, when you want to exit stocks and really hone in on bonds and gold. Yield curve normalization. Number two, the imminent doom indicator. And number three was, let me find number three. It was, boom, it was this chart. It was XLU. So S&P 500 utilities or staples, doesn't matter, relative to the S&P 500. So XLP relative to SPY. And I want to take a look at the weekly chart. Boom. So what do I want to see on this chart? This is the defensive sector in the S&P 500 relative to the rest of the S&P. It makes total sense. It is underperforming the S&P in the long term. However, we do have some periods of outperformance where defensives lead the S&P, and these usually coincide with troubled waters, right? When the market, when the economy is kind of teetering, is in trouble, and when we have a nasty old kind of recession, right? This is the S&P down here. This is the relative ratio chart. So what do you want to see on this chart? Pretty straightforward. First, you want to see eminent doom indicator signal triggered, check mark, right? Boom. Yield curve normalization, boom, check mark. Final check is XLP relative to S&P. You want to see it close above the 50-week moving average. That is this green moving average. Once that happens, once you get a weekly closure above the 50-week moving average, like this example, it coincides with the market top fairly accurately. Not perfect. Next best thing, I would say. Next best thing. Let's take a look. We had not perfect here, right? Because we had kind of sideways ratio chart. So in this example, I'd be looking at the ratio chart to exceed these prior highs. Kind of happened here. And if I drop a line, it coincided with the topping process, right? But in this example, it's more difficult because the market, or I should say the ratio chart, is moving sideways, which is completely different from this look, right? It is moving down. So any close above the 50-week moving average would signal a major change in market leadership away from the S&P, AI trade, Nvidia, etc., and into defensive staples. So let me just cover the VIX. Let me end with the VIX in here. So the VIX is now trading inside of this kind of channel, right? One of the hallmarks of a major market top is when the VIX does what? When the VIX does what? When the VIX does this. Breaks out, comes back down, and forms a higher base. That's a pretty bad sign. It usually means market top pretty close. Not there, but pretty close. Let me show you what happened in 2008, as it kind of looks identical to this. Let's go back to 2007, 2008. Here it is. Okay. Take a look at this. So this is the VIX. We had this breakout in the VIX, went back down to make a higher low, right? Then broke out again. Look at this. Major break. Formed another higher low, right? Keeps establishing these higher ranges, right? So we are in here. So not really at the top, but pretty close. Let me add the S&P so we can kind of visualize where we are in the cycle. This is the S&P 500 and kind of in here. Actually, not even in there. We're kind of here. First kind of pull back. We're in here, right? Not back at the prior high. Likely will exceed that prior high in the next couple of months and then top sometime early next year, late this year, right? Somewhere in here. Let's actually measure that. Let's take a look at how many days we're looking at. So 3 months. Yeah, perfect. Yeah, that makes total sense to me. Sometime topping sometime this year or potentially early next year. That's kind of what I'm looking at. And the VIX kind of says the same thing. And let's go back to the VIX. So the VIX did break out today as participants were hedging. Market participants were actually hedging today. Unlike yesterday, they were not interested in shorting the market yesterday. Today, they bought a bunch of puts. And it turns out they were kind of right because Nvidia is kind of getting dumped post-market. With that being said, we did not exceed this prior high. Even though the market moved lower today, we did not exceed this prior high. This tells me likely we get another spike tomorrow. That'll very likely call the market bottom, near-term bottom that is, and we'll get a breakdown back in the VIX as the market rallies. Let me again add the S&P so you guys can see what I'm talking about in here. So this is the S&P 500. And if we actually take a look at the S&P, it matched this prior low almost exactly 555. The VIX did not exceed this high. That's bullish. So if we get another flush down tomorrow in the S&P, then the VIX does something like this. Maybe forms kind of a hammer candle that looks kind of like this. Not as big as this. Let's do this again. Kind of like this, right? To me, that'll tell me that likely the market has bottomed, especially if we tag that 547 level of support. Let's close this out with key events. Tomorrow we'll have the GDP numbers for Q2. This is the first estimate, so it's important. And then Friday we'll have PCE. PCE is a lagging indicator. We already have the CPI come in a couple of weeks back. Usually PCE will follow the same kind of read in the CPI. So expect bullish CPI, lower than expected inflation. And then if the GDP numbers are fairly good, then again, likely expect that fake out move to the downside tomorrow, flush out those weak hands in Nvidia, complete that bottom on the S&P 500 at 547. For the NASDAQ 100, that likely means potentially we fill this gap. I'm not sure yet. I don't really base my entries and exits based on what the NASDAQ 100 does. Kind of finicky. It's a kind of finicky index. So I'll be looking at the S&P, and if we hit 547, to me that'll probably mean we have bottom. If that means the Nasdaq is at 463, 465, doesn't matter. That will likely mean both indices have bottom. I hope that helps. Smash that like button on your way out, and that's all I have for you tonight. Bye.
Oh, wow.